Investors poured money into mining stocks, expecting profits from valuable mineral deposits, but many of those mines never produced anything. Companies announced discoveries of gold and silver, and stock prices surged as buyers rushed to secure shares before extraction began. Certificates confirmed ownership in mining ventures, and investors believed these papers represented real stakes in profitable operations. Money flowed into these companies through stock sales, and rising prices reinforced the belief that the mines were valuable. Reports described rich deposits and future output, creating confidence even when no verified production existed. A comparable situation unfolded in later mining scandals, where claimed discoveries drove investment before verification exposed the truth. Investors committed savings based on projected returns, expecting dividends once mining operations became active. Requests to verify output were delayed, and companies continued promoting growth while production remained unclear. What appeared to be investment in real mining ventures was actually a system where shares were sold, but the underlying value was never proven. That surge in investment didn't appear suddenly, as earlier mining markets had already shown how speculation could grow before real production was ever confirmed. In the 19th century, a comparable situation unfolded during gold rush expansions, where mining claims and company shares attracted thousands of investors despite limited verified output. Mining companies issued shares tied to land claims, and buyers treated these stocks as direct access to valuable mineral deposits. Ownership was represented through certificates, and investors relied on reported discoveries rather than confirmed extraction results. Communication delays and limited verification meant that information about mines spread faster than the ability to confirm whether deposits actually existed. Companies promoted their claims through reports and announcements, and early investors interpreted these signals as proof of future profitability. Stock markets allowed shares to be traded quickly, and rising prices reinforced confidence, even when production remained uncertain. Large numbers of investors entered the market, allocating savings into mining stocks based on expectation rather than verified performance. This environment allowed the mining stock scam to take hold, where belief in reported discoveries replaced the need for proven output. Mining companies positioned new discoveries as immediate investment opportunities, and investors paid for shares, expecting returns before any extraction was confirmed. Announcements described rich gold and silver deposits, and these reports triggered rapid buying as investors tried to secure early positions. A similar mechanism played out during 19th century gold rush speculation, where reported finds drove demand even when output remained uncertain. Shares were issued based on claimed land rights, and buyers treated these stocks as direct stakes in future mining profits. Money moved quickly through stock purchases, and rising prices created the impression that the underlying mines were valuable. Investors increased their exposure by buying additional shares, expecting resale gains as demand continued to grow. Decisions followed these expectations, with individuals reallocating savings and prioritizing mining stocks over other investments. Companies expanded share offerings, increasing supply without providing verified evidence of production. This gap between claimed discoveries and proven output created the opportunity that allowed the mining stock scam to expand. The mining stock scam operated by converting reported discoveries into tradable value, where companies issued shares tied to deposits that had not been independently verified. Promoters released geological reports and announcements describing high-grade ore, and investors interpreted these claims as confirmation of profitable extraction. Stock certificates represented ownership in mining ventures, and buyers treated these documents as proof of real economic value. Money moved through continuous share trading, and rising prices reinforced the belief that the mines were producing or about to produce valuable output. The same claims were repeated across reports, attracting new investors, while existing shareholders held positions expecting further price increases. Verification was delayed because production data was limited, and investors relied on company-issued information rather than independent inspection. Decisions escalated as more capital entered the market, and companies used this momentum to issue additional shares without confirming actual yield. Because mining sites were remote, most investors had no direct way to assess whether extraction was taking place as reported. This mechanism allowed the mining stock scam to function as a system where reported value drove investment, even when underlying production remained unproven. As early investors saw stock prices rise, the mining stock scam expanded as more buyers entered, expecting continued gains from the same reported discoveries. Companies issued additional shares tied to the same mining claims, increasing supply without confirming whether production justified the valuation. Promoters released updated reports and projections, reinforcing the belief that extraction would soon validate the rising stock prices. Money continued to flow into these companies, and increasing demand created a feedback loop where price growth appeared to confirm underlying value. Decisions escalated as investors committed larger amounts, reinvested profits, and encouraged others to enter the market. Stock trading activity increased, and shares were bought and sold based on expectation rather than verified output. Companies used rising valuations to attract further investment, presenting expansion plans that relied on future production. Because verification remained limited, most investors accepted reported progress without direct evidence of mining results. This phase allowed the mining stock scam to scale rapidly, as confidence in reported discoveries drove investment beyond what the mines could actually produce. As investors began seeking confirmation, discrepancies appeared between reported discoveries and actual production, and output figures could not be independently verified. Some shareholders requested detailed extraction data, but companies delayed responses or provided inconsistent reports about mining activity. Analysts and observers questioned the quality of reported ore, as independent inspections failed to confirm the richness described in company announcements. Conflicting information emerged when different reports described the same mining sites with varying levels of productivity. Investors who attempted to visit mining locations found limited activity, raising doubts about whether extraction was taking place as claimed. Stock prices began to fluctuate as uncertainty increased, and confidence weakened when promised results did not materialize. Requests for transparency grew, but companies continued promoting future potential rather than addressing current discrepancies. Market participants started to recognize that reported value was not supported by measurable output, creating tension between expectation and reality. These warning signs exposed the growing gap between claimed discoveries and actual mining performance within the system. The mining stock scam came to the surface when independent verification attempts confirmed that reported deposits were overstated or did not exist at the levels claimed. Investigations began as analysts, investors, and authorities reviewed geological reports, and discrepancies between claims and actual samples became evident. Production records failed to match earlier announcements, and companies could not provide consistent evidence of profitable extraction. Investors reacted by selling shares, and stock prices dropped rapidly as confidence in the reported discoveries collapsed. Decisions reversed across the market, with investors withdrawing capital, abandoning positions, and attempting to recover losses. Trading activity shifted from aggressive buying to panic selling, accelerating the decline in stock valuations. Companies that relied on continued investment faced immediate financial pressure as new funding stopped and operations became unsustainable. Some inquiries revealed that information had been exaggerated or misrepresented, confirming that the system had operated on unverified claims. The mining stock scam collapsed when verification replaced speculation, exposing that investment had been driven by reported value rather than proven production. The mining stock scam followed a repeatable structure where reported discoveries were treated as proven value, allowing companies to raise capital before confirming actual production. Promoters separated investment from verification, enabling money to move quickly while evidence of extraction remained unclear or untested. Investors relied on reports, announcements, and rising prices, treating market momentum as proof of underlying value. The system allowed expansion through repetition, where the same claims could attract new buyers without additional verification. Intermediaries and market activity reinforced trust, creating a feedback loop where price increases validated unproven discoveries. Verification was delayed by distance, limited data, and reliance on company-issued information, allowing the system to scale before being challenged. The exposure phase showed that confirmation only occurred when independent checks were performed and discrepancies became undeniable. Real-world outcomes followed, including rapid financial losses, capital withdrawal, and loss of confidence in similar investment structures. The lesson remains consistent. When investment decisions rely on unverified claims rather than confirmed output, the system itself becomes the scam.